Welcome to The Explainer. Today, we are totally pulling back the curtain on the global economy to reveal what is basically a giant magic trick being played with your wallet. We're talking about money, inflation, and the invisible levers that control everything from the price of your morning coffee to the interest rate on your mortgage. So grab a seat because we are going to look at the financial system in a way that might just blow your mind. All right, let's kick things off with a question that seems super simple, but I guarantee your high school textbook got it totally wrong. I mean, ask anyone on the street where money comes from, and they'll probably tell you the government prints it at some giant, highly guarded mint. But in the modern economy, physical cash and coins make up just a tiny, tiny fraction of the money in your world. Get ready for this. A staggering 97% of all money in the economy is created entirely out of nowhere by commercial banks. Yeah, you heard that right. That bank down the street isn't just holding your cash, they are an active money printing machine, just, minus the actual printer. Section 1, The Great Money Illusion. So, to really grasp this wild reality, we gotta bust the biggest myth in economics. Most textbooks say banks are just giant piggy banks playing the middleman, right? The story goes that I deposit my savings and the bank turns around and lends that exact same money to you for your new house. But the reality is completely backward. Banks do not lend out pre-existing money. Actually, making a loan is what creates the deposit. When you borrow money, the bank doesn't check the vault to see if they have enough cash. They literally conjure new money out of thin air the literal second they approve your loan. Section 2. Keyboard magic, creating money. Forget about those heavy printing presses and giant vats of green ink. We're talking pure digital magic here. Most money in the modern economy is just what economists delightfully call fountain pen money. It's basically a digital illusion typed into existence the minute you sign a mortgage or a business loan. The bank simply credits your account with a newly typed number, and boom, brand new money enters the economy. Now, you might be wondering, how on earth do they get away with this legally? Well, it all comes down to an accounting loophole. Because banks are exempt from what are known as client money rules, they can take the liability of a loan, which is what they owe you, and simply rebrand it on their books as a customer deposit. Then, we all log into our banking apps, see that fictitious deposit, and treat it as totally real cash to buy cars, groceries, and houses. It's honestly such a well-kept secret that an actual banking expert warned researchers to literally never mention the phrase accounts payable in banking. Why? Because calling it what it actually is totally gives the magic trick away. If everyone suddenly realized bank deposits were just renamed liabilities, the whole illusion might lose its mystique. And just in case you think we're putting on our tinfoil hats here, the Bank of England's own official reports literally show exactly how issuing a new loan conjures brand new money onto the private sector's balance sheet. When a loan is issued, the bank's assets and liabilities both expand at the exact same time. New broad money is officially created. It's completely acknowledged by the big players, yet it is so counterintuitive to how we think about our own personal finances. Section 3. The Money Multiplier Effect. But wait, the magic trick doesn't stop at just one loan. Thanks to something called fractional reserve banking, a single deposit sets off this massive chain reaction. Say you deposit $1,000. The bank only has to hold a fraction of that, let's say 10%, in reserve. They lend out the remaining $900. Then that $900 gets spent, ends up in another bank account, and that bank lends out 90% of it. This cycle just keeps repeating, multiplying the money supply like a wizard magically duplicating gold coins. Now, there are actually two magicians working this stage. While everyday commercial banks are the ones aggressively typing credit money into existence through all these loans, the central bank is the ultimate puppet master. They control the base money, or what's called high-powered money, setting the rules, the reserve requirements, and the interest rates that are supposed to keep the commercial banks in check. Section 4. Taming the inflation monster. Which brings us to the billion-dollar question: if banks can just create money forever, why aren't we all billionaires? Or better yet, if everyone has billions of dollars, why doesn't a single loaf of bread cost $1 billion? Well, it's because of this. As the famous economist Milton Friedman noted, inflation is a monetary phenomenon. Money creation is definitely not consequence-free. When banks create too much money and all that cash is out there chasing too few goods and services, it summons the dreaded inflation monster. The value of your money goes down and prices just shoot straight up. Of course, inflation doesn't always come just from banks printing loans. It can be triggered by a booming economy where absolutely everyone is spending, or by supply shocks like energy spikes and global conflicts. I mean, remember that wild post-lockdown demand surge where you couldn't buy a bicycle or a graphics card to save your life? That crazy demand, mixed with businesses raising prices to cover their own higher costs, creates a perfect storm that eats away at your purchasing power like a hungry little gremlin. Section 5. The interest rate lever. To slay this monster, the central bank steps in, basically acting as the grumpy dad of the economy. When the party gets too wild, they march right over to the economic thermostat and pull their magic lever: interest rates. This thermostat has two main settings. When the economy is freezing and growth is dropping, they use an expansionary policy. They lower rates to heat up lending, making loans super cheap so businesses and consumers will borrow and spend. But when inflation boils over and the economy is running way too hot, they switch to a restrictive policy. They crank interest rates up, making borrowing painfully expensive just to cool everything down. This whole transmission mechanism works like supply and demand magic. By tightening up the supply of loanable funds in the money market, the central bank basically forces interest rates to spike. When the cost of getting a loan goes up, investment and consumption inevitably drop. As a result, aggregate demand crashes right back down to earth, dragging those sky-high prices down with it. Let's make this super personal for a second. How does this actually hit your wallet? Well, when the central bank pulls that restrictive lever, mortgages and car loans suddenly cost a whole lot more. And because you're paying more to the bank every month, you have way less disposable income for shopping or dining out. Businesses notice you aren't buying, so they stop expanding, and they freeze hiring. Ultimately, demand drops so much that stores are literally forced to lower their prices just to win you back. It is a completely deliberate, engineered shock to your wallet. Section 6. The ultimate balancing act. So, how exactly do central bankers keep this entire circus from collapsing? They don't just randomly guess when to pull the lever. They actually try to follow guidelines, like the Taylor Rule, which is this neat little economic formula. It helps them balance the interest rate thermostat against inflation targets and economic growth. The ultimate goal here is to achieve what economists call a mythical soft landing. This magical, perfect scenario where they raise rates just enough so that inflation dies, but the economy survives without totally crashing into a recession. But, as you can imagine, pulling that interest rate lever too fast or too hard is wildly dangerous. It's an incredibly high-stakes trade-off. They want to cool down spending, but if they go too far, boom, they trigger a massive recession. They want to stop price hikes, but they risk causing bankruptcies and mass unemployment. It's basically trading the monster of inflation for the very real nightmare of an economic depression. Which leaves us with a totally mind-bending reality. You aren't just some passive consumer complaining about prices at the grocery store. Whenever you take out a mortgage, swipe a credit card, or sign a business loan, you are an active participant in this magical, messy, money-creating machine. You are literally pulling the levers of the global economy right alongside the central banks. So the next time you borrow, remember the magic trick you're helping perform.